Today we're talking about something that feels boring right up until it breaks your business. Financial reporting. Not taxes, not budgeting as a concept, but the day-to-day quality of your financial reports. Because when reporting is messy, late, or just plain inaccurate, the real cost isn't the bookkeeping bill. It's the deals you don't get, the valuations you don't deserve, and the decisions you make while basically driving with fogged-up windows.
And it's sneaky, too. A lot of leadership teams think, we're fine. We're growing. Cash is coming in. But poor reporting doesn't usually show up like a flashing red light. It shows up like friction. A lender asks one extra question. An investor hesitates. Your finance team can't answer, what's our gross margin by product, without a 2-week scramble.
Exactly. So let's break down the hidden costs. We'll hit lending and capital valuation, due diligence, and then the less obvious one, your ability to manage operations and actually create value. And if you're listening thinking, we're not big enough for this to matter, I'd argue it matters most before you're big enough to absorb mistakes.
Let's start with lending and access to capital because that's where people feel the pain fastest. Banks and lenders don't just want your story. They want evidence. Clear P&Ls, clean balance sheets, consistent reporting, and explanations that don't change every time someone asks.
And lenders especially care about predictability and controls. If your reporting is sloppy, the lender hears, we might not know our numbers, which quickly becomes, we might not know our cash. And that becomes, this is risky.
Here's how that translates into cost. Sometimes it's a flat denial. But more often it's a higher interest rate, tighter covenants, smaller credit limits, or more frequent reporting requirements. Basically, you pay for uncertainty.
Yes, and covenants are worth pausing on. If your financials aren't reliable, you're more likely to trip covenants accidentally or be unable to prove compliance. And even if you're actually fine, you can still be in default on paper. That's a brutal position to negotiate from.
Also, the process takes longer. Poor reporting creates time cost. Every financing process has a momentum curve. When you lose momentum, you lose leverage. Your lender or investor starts thinking, if the numbers are this hard now, what happens when things get stressful?
Now, let's talk valuation, because this is where teams don't realize how directly reporting affects the price of the company. People assume valuation is just a multiple of revenue or EBITDA, but the multiple is basically a confidence score. Cleaner reporting increases confidence. Confidence increases the multiple.
Totally. If the buyer or investor believes your EBITDA is real, repeatable, and well supported, they'll pay more for it. If they suspect it's inflated by timing issues, missing accruals, messy revenue recognition, or one-time items that aren't labeled, they'll discount it.
And they don't just discount it abstractly. They do it in very concrete ways. They might propose an adjusted EBITDA that's lower than yours. Or they'll push more of the purchase price into an earnout. Or they'll insist on holding back cash in escrow, just in case your numbers unravel.
Here's a simple example. If your reporting can't separate recurring revenue from one-time revenue, you might still get credit for top-line growth, but you won't get credit for quality of revenue. And quality of revenue is what gets premium valuation.
Another common one, customer concentration and churn. If your reporting can't clearly show retention by cohort or revenue by customer group, the market assumes the worst. Even if you're strong, you can't prove it. And in deals, what you can't prove often doesn't count.
Let's move into due diligence, because due diligence is where poor reporting stops being an annoyance and becomes a deal risk. Diligence is basically the other side asking, is this business what you say it is?
And if you've ever been through diligence, you know it's not just about providing documents. It's about responsiveness, clarity, and consistency. If your financial package this month doesn't tie to last month, or your balance sheet doesn't reconcile cleanly, or your revenue numbers shift after the fact without a solid explanation, that's a problem.
And it triggers deeper questions. One inconsistency leads to 5 more requests. It's like pulling on a thread. The buyer's team thinks, if we can't trust the basics, we have to verify everything. That increases diligence cost, slows the timeline, and again, reduces your leverage.
This is where hidden costs become very visible costs. You'll pay more to your accountants, finance team, and advisors because everyone is doing rework. You might even have to do a quality of earnings type cleanup while the deal is already in motion, which is the most expensive time to do it.
And a slow diligence process increases deal fatigue. The longer it takes, the more chances something changes. Buyer priorities shift, markets move, financing dries up, or your own numbers dip, and now you're explaining not only inconsistencies but also performance.
Plus, diligence findings can become price chips. Even if there's no fraud and no disaster, the buyer can say, "We found weaknesses in reporting and controls." That's risk. Risk means a lower price. They're not being mean. They're pricing the uncertainty.
Now let's talk about operations, because honestly, this is the cost that hits you every month, whether you fundraise or not. Poor reporting makes you worse at running the company.
Yes, financial reporting is your feedback loop. If it's slow, you learn late. If it's inaccurate, you learn the wrong lesson. And if it's too high level, you can't act on it. You can't manage what you can't see.
Let's get specific. If you don't have accurate cost information, you won't know your true gross margin. That means you might invest heavily in the product line that looks like a winner but is actually barely profitable once you allocate costs correctly.
Or you might cut the wrong expenses. When companies feel pressure, the typical move is to freeze hiring, slash marketing, or reduce customer support. But without good reporting, you can't distinguish between cost that is waste and cost that actually creates growth or retention.
And it impacts cash in scary ways. A business can be profitable and still run out of cash if reporting doesn't highlight working capital trends. Are receivables creeping up? Are you relying on a few big customers paying late? Are inventory levels rising? If you can't see those patterns early, you react late.
There's also the management bandwidth cost. Leaders end up in meetings arguing about what the numbers are instead of what they mean. When reporting is poor, every conversation starts with, "Do we trust this?" That's exhausting, and it erodes trust internally.
Another big one, forecasting. People love to say forecasting is guesswork. But good forecasting is structured guesswork built on reliable history. If the historical data is messy, the forecast becomes vibes. And then you end up overhiring, underhiring, overordering, or missing growth opportunities because you're cautious.
And that ties into value creation. Strong reporting lets you find levers. Pricing, customer acquisition cost, lifetime value, product profitability, churn drivers, and operational efficiency. Poor reporting hides the levers. So improvement becomes random. You try 10 things. Hope one works.
Let's hit a few more hidden costs that don't always make the headline. One is reputation with stakeholders. If your board, investors, or lenders get inconsistent reports, they start asking more questions, requesting more detail, and generally trusting you less.
And the irony is that can happen even if the business is healthy. You can have a great company with weak reporting, and the weak reporting becomes a story. People start worrying about governance instead of performance.
Another cost is talent. Great finance people want to work in environments where the basics are respected. If accounting is perpetually behind and leadership treats reporting like a nuisance, it becomes harder to hire and keep strong finance talent.
And then there's system cost. When reporting is weak, teams often patch it with spreadsheets and manual processes. That works until it doesn't. The hidden cost is errors, version confusion, and key person risk. If one person owns a magic spreadsheet and they leave, you're in trouble.
So what does good actually look like? Not perfection. Not close the books in 2 days for everyone. But a few practical markers: consistent month-end close timing, clear definitions for metrics, reconciled accounts, and financials that tie out month to month.
And reporting that helps decisions. A solid P&L is table stakes. The real win is getting visibility into drivers, revenue by product or service line, margin by offering, payroll and contractor costs mapped to functions, and cash flow explained in plain language.
Let's also say this out loud. The hidden cost conversation is not about shaming small businesses that can't afford a huge finance team. It's about matching your reporting maturity to your business reality. If you're trying to raise capital, take on debt, acquire a company, or sell, the bar rises fast.
And there are smart ways to level up without overbuilding. Establish a monthly close checklist. Clean up your chart of accounts so it tells a story. Separate one-time items. Document policies like how you recognize revenue or categorize expenses. These sound boring, but they save you real money.
One last point. Bad reporting isn't just a finance problem. It's a leadership problem. Sales needs to understand how bookings become revenue. Operations needs to track cost drivers. The whole executive team benefits when numbers are shared, consistent, and understood.
So if you take nothing else from this episode, take this. Messy financial reporting is not neutral. It quietly taxes your company in higher capital costs, lower valuation, slower deals, and weaker decisions. Clean reporting doesn't just make accountants happy. It makes your business more valuable.
And if you're wondering where to start, ask a simple question. If a lender or buyer asked for your last 12 months of financials today, would you feel confident sending them within 24 hours? If the answer is no, that's not a moral failure. It's just a signal. And signals are useful, because now you know where the leverage is.
That's it for today. Next time, we can dig into what a clean monthly reporting package actually includes and how to build one that doesn't take over your life. Until then, keep your numbers close and your assumptions closer.